Hello, everyone. My name is Ted Baumann. I am Chief of International Diversification here at International Living, and part of my job is to keep track of issues that can affect U.S. expats like me. I'm a dual citizen of the United States and South Africa and a taxpayer in both countries, and both countries' laws apply to me. Now, for that reason, I was pretty much shocked to hear about a new proposal contained in the so-called One Big Beautiful Bill that was recently passed by a single vote in the House of Representatives. The bill that's supposed to essentially enact all of President Trump's domestic agenda over the next few years. Now, why was I shocked? Well, there was a provision buried deep inside the bill, so big and so deep inside the bill that even people, congressmen who voted for the bill didn't know it was there, that says that a 3.5% excise tax will be imposed on transfers of funds from U.S. financial institutions to foreign financial institutions if the people sending that money qualify under certain criteria. Now, technically, this law is aimed at non-citizens. So if you are a tech worker, for example, on a visa working in Silicon Valley and you send money back to an account at home, then you'd have to add a 3.5% tax to the cost of living and working and sending money outside the United States. If you are a farm worker who works in this country periodically during harvest season, as many Mexicans and other Central Americans do, presumably the same thing would happen. If you go to a Western Union to send money back to your family in Guatemala or wherever you come from, you're going to lose 3.5% of that money that typically people in those countries can ill afford to lose. Now, the law doesn't technically apply to U.S. citizens like me. I'm a dual citizen of the U.S. and South Africa, but it does worry me nonetheless, and that's because I have experience of these matters. Now, the law says that money sent by a person located in the United States, and it doesn't specify whether it's the person themselves or the money themselves or the bank themselves, that's left unaddressed, that a person located in the United States who sends money to a person outside the United States, including themselves if they have a foreign account, is subject to this 3.5% excise tax, which, by the way, was originally supposed to be 5%, but was chiseled down to 3.5. Now, the only way you can avoid this if you're a U.S. citizen is to prove your citizenship. How that works? There's nothing in the law that says how it works. Who has to do it? Basically, the companies that handle money transfers, companies like Western Union or Zoom or Remitly or others that people use, they will have to verify your citizenship status so that they don't have to end up paying that 3.5% on your behalf if it turns out that you're not eligible to avoid it. Now, what does that mean in practice? Well, I've seen this happen many times with US-based financial institutions. They err on the side of caution. They err on the side of avoiding trouble for themselves. So what I think is going to happen is that they're not going to want to be in the business of verifying citizenship but from their customers. So the law provides that if the money is not withheld by the company, then the company itself has to pay that money on behalf of the person who sent it abroad, which means they lose 3.5% of the transaction value from their income and their profits. So what are they going to do? They're going to deduct 3.5% from everybody and then let us go back and reclaim that money on our income taxes, which is one thing the law does say, that if you end up paying this 3.5% and you're not supposed to because you're a U.S. citizen, then you can get a rebate or a refund at tax time. That's not what anybody wants. Nobody wants to have to be hit with a 3.5% excise tax or any tax at all simply because we are sending money abroad. Now, for somebody who, like me, lives and works abroad, every month I receive income from clients and so on, and that money then I transfer into, some of it anyway, into my South African accounts so I can live. Now, a 3.5% extra tax on that is a pretty big deal when you add it up over time. It doesn't sound big, but it's enough to make a difference. Now, I predict that most U.S. money transfer companies are going to try to avoid being in the position of having to A, verify citizenship status of their clients, and B, having to be a tax collector and send those tax proceeds to the U.S. government by simply slapping the excise tax on everybody and letting them deal with it at the end of the tax year when they file their income taxes. Now, To me, that's an absolutely terrible idea. And one of the reasons for that is because we expats have already experienced what it's like when financial institutions are afraid of the US government because of silly rules like this. Back during the Obama administration, after the global financial crisis, Congress included a provision in one of the bills designed to respond to the crisis that effectively created a separate class of taxpayers, those of us who live outside the United States. It's called the Foreign Account Tax Compliance Act. And what that bill says is that if you have a certain amount of money in a foreign financial institution, safety deposit box, invested in a foreign country, all sorts of things, you have to tell the U.S. government about the existence of that money. Now, that doesn't mean you have to pay tax on it, but you have to tell the government that that money is there. Now, people who live and work and keep their money inside the United States don't have to do that. So effectively, those of us who live abroad are treated as different types of citizens, different types of taxpayers, for no good reason other than the fact that we're vulnerable. And there aren't enough of us as expats to be able to make a difference at the state and congressional district level to protest these laws. It's not like people are going to go out in the streets and protest against laws that affect U.S. expats. Well, for those of us who are subject to them, it can be a real bother. Every single year without fail, my South African bank sends me an email saying, we're going to suspend your account if you don't prove to us that you are compliant with U.S. Tax reporting laws, and to do that, you have to give us a W-4 form. Think of that. Just because the U.S. government is such a bully and because they put so much pressure on foreign banks under the threat of withholding their ability to transact in dollars, they have to enforce U.S. law on me, even though they are not U.S. banks, U.S. companies. Now, that's a pretty bad situation. It has led foreign banks to drop U.S. clients. And I predict that this could have a similar effect on those of us who rely on money transfer companies. Now, I would like to know, for example, why Congress thought this was a good idea. I think I know the answer. I think the answer is that they know that non-citizen people working and earning money in the U.S., sending money abroad, are vulnerable because they're not citizens. If you're a high-powered tech worker from a place like India, working in Silicon Valley, you earn a lot of money. You don't want to disturb your visa status by making a noise about a silly regulation or law or tax like this. On the other hand, if you're a farm worker working here seasonally, like I said, sending money back through Western Union or something, you also don't want to make waves because that could also end up badly for you. Of course, the other flip side of this is that people around the world who depend on remittances from the United States are looking at a 3.5% decline in the income that they have expected. Now, I would expect that many U.S. voters don't give a fig about that, but the reality is that it's once again something that the United States is doing to show that it is effectively not a good place for foreigners to live and work. Now, what can you do to protect yourself from this? Well, the first thing you can do, I think, is that if you have money that you are planning to send abroad, let's say for a property purchase, something that I did earlier this year, send it over now so that you don't have to become entangled with these laws, particularly if you're sending substantial amounts of money. Several $100,000, even at 3.5%, can add up to quite a big hit. The other thing you could do is to sign up for money transfer agencies that are not technically based in the United States. The one I use is Wise, and although the initial deposit must be sent to their U.S. bank account in New York, subsequent deposits can be deposited directly and credited to your account, which is technically held by the the bank, or Wise rather, which banks in the United Kingdom. And that means that you can avoid this net altogether. I think that's going to be the case. However, there's no way of telling. It depends on how the law is interpreted. And it's so vaguely written that nobody really knows. What does it mean to be located in the United States? Are we talking about myself personally? Because I'm not right now. Are we talking about a bank account? I do have one in the United States. Are we talking about the origin of the money? Yes, I do have employers and clients who are based in the United States. But which one of those makes me eligible to be taxed under this law? Nobody knows. So, as I said, what I predict is that the companies who handle money transfers are going to err on the side of caution by making sure that we pay first and have to reclaim later, which is yet another unwarranted, unnecessary, and irritating effect that U.S. law has on U.S. expats. Anyway, this is Ted Baumann, Chief of International Diversification at International Living. I'll be keeping close eye on this issue as well as other issues that affect U.S. expats, and I'll keep you updated as things develop. Take care.